Good morning, boys and girls, or good afternoon. This is the Liberty Call for Tuesday, January 25th, 2022. Hope everyone's having a fantastic day out there. We're getting pummeled with about a half foot of snow right now. So I have a date with a snowblower either this afternoon or tomorrow morning. So awesome for me. So hope everyone's having a great Tuesday out there. If it's your first time watching, be sure to subscribe and like or share with friends and family. I would greatly appreciate it. Let's go ahead and take a look and see how the markets did today. It was another roller coaster day like we had yesterday. I mean, not quite as volatile, but definitely not ideal. Dow Jones closed down 0.19% at 34,297. The S&P 500 was down 1.22%, closing at 4356. Nasdaq was down 2.28%, closing at 13,539. Small caps were down 1.41%. The VIX was up 4.21% today, closed at 3116. If you remember from previous videos, anytime the VIX is over 30, it is a sign of concern. So let's keep an eye on that. You know, if it does subside over the next couple of days, no harm, no foul. If it continues to stay above 30, you might want to start making evasive maneuvers, if you haven't talked about it with your financial professional. All right, across Europe, mostly green. Looks like the best was the Bovespa and the FTSE. And down across Asia, mostly red. So yeah, mostly red across Asia, mostly green across Europe, and then red across the United States. So kind of a mixed day across the world. But again, it did come back quite a bit from where we were at. I think the Dow was, it closed down 66 points. It was down as much as 300 or 400 today. Yesterday, it was down 1,100 points and finished in the positive. Today, went into the positive for a while and then, finished slightly in the red. So, all right, I have a few articles I want to burn through today. This first one, these 12 U.S. states have restored employment levels to pre-COVID. Right. This comes from Bloomberg. Employment is back at or above pre-pandemic levels in a dozen U.S. states. Compared with February of 2020, Arizona has added the most non-farm jobs in its payroll, followed by Florida, Utah, Wisconsin, and Oregon, according to December data released Tuesday by the Bureau of Labor Statistics. In addition, 20 states plus the District of Columbia payrolls are within 50,000 jobs of recovering. So, so if you put that in with Arizona, Florida, Utah, Wisconsin, and Oregon. So 25, over half the states are either above or very, very close to where they were. The remaining states are collectively missing about 3.5 million jobs, concentrated in three of the most populous states, California, New York, and Pennsylvania, as well as Michigan. California alone is about 750,000 below its pre-COVID level. The data show how uneven the recovery has been in the labor market, with most missing jobs located on the coasts. Population growth and pandemic migration help explain why. Prediction data from the Bureau of Labor Statistics showed that a net of 8,600 people over 16 left New York State every month over the last 22 months. By contrast, the population grew in Texas, Florida, and Arizona. The net gain in Texas equates to more than 950 people per day during that period. So, some good news. Obviously, excuse me for a second. I got a frog. All right, excuse me for that. So, like I said, that is good news that half the states are almost back on track. There are a lot of people who are leaving the more tyrannical states. They know who they are. I don't have to point them out. California, New York. But like I said, things are better, if you look for the good signs, but obviously it's not everywhere. All right. Next article goes to oil resumes climb out on Ukraine, U.S. rate hike, and gasoline stocks in shadows. This is written by Bharani Krishnan from investing.com. The rally in crude oil returned Tuesday after a two-day respite, as worries of a potential Russia-Ukraine war helped longs maintain a positive narrative on the market, despite forthcoming U.S. weekly data that could show another uncomfortable build in gasoline stocks. Wall Street's renewed tumble on U.S. rate hike fears Also did not hit the oil market as it did on Monday. The West Texas Intermediate benchmark for U.S. crude settled up $2.29 or 2.8% at 85.60 a barrel. WTI fell 2.2% on Monday. London-based Brent, the global benchmark for oil, finished up $1.93 or 2.2% at 88.20 per barrel and had lost 1.8% in the previous session. The market remains fundamentally bullish and conflict with Russia does nothing to alleviate supply-side pressure, said Craig Earlham, analyst at online trading platform Owanda. If anything, the risks are tilted in the other direction. Western nations continue to press for a diplomatic outcome on Tuesday to the escalating Russia-Ukraine crisis, even as American troops were placed on high alert for possible deployment to Eastern Europe while NATO dispatches additional ships and fighter jets to the region. Yeah, I saw that the Netherlands was sending two whole F-35s to, I forget where they were sending them off to. So, wow. Well, those two fighter jets, I bet the Russians are just quaking in their galoshes. Moscow has repeatedly denied any intent to invade, blaming Washington for increasing tensions in the region. Now, I think that's true. Beating the war drums is always good for business. I'm sure Raytheon and Boeing and Lockheed Martin, they all are just, rubbing their paws together, hoping to blow up a whole bunch more people. And, of course, those fighter jets go for about 30 million a piece, or at least they did back when I used to work on them. Oil traders have, meanwhile, seized the opportunity to chase prices higher on the war narrative. Crude prices in the OPEC Plus alliance have also pumped less over the past month, reinforcing the theory of undersupplied market. In the United States, the world's number one oil consumer, the supply-demand picture for oil has been somewhat different. Tuesday's market rebound came ahead of weekly data from the U.S. Energy Information Administration that could be mixed at best, ahead of the EIA report due at 10:30 a.m. Eastern on Wednesday. The American Petroleum Institute will issue a snapshot at around 4:30 p.m. today of what last week's stockpiles of crude and fuel products could have been. According to industry analysts tracked by investing.com, crude inventories likely fell by 728 barrels last week versus the build of 515 barrels reported by EIA for the previous week to January 14th. Distillate inventories are expected to have fallen by 1.26 million barrels, adding to the previous week's decline of 1.43 million. But gasoline stocks likely jumped by 2.54 million barrels on top of the previous week's rise of 5.87 million barrels. Gasoline barrels have ballooned by a record nearly 24 million barrels over the past 3-week period amid seasonally weak U.S. demand that contrasts with the rally in global oil prices. So, we've seen oil go up into the mid to high 80s over the last 2 months now. So it's it's an uncomfortable feeling for those of us who drive cars and buy food, which has to be shipped to us. So I think it'll come back down. I know each Friday I go through the number of oil rigs online, and we are still probably 150, 200 rigs offline at this point. So that is a significant crunch at this time. So we'll see where it goes. All right, next story. U.S. consumer confidence dips. More plan to buy big ticket items. This is written by Lucia Mutikana from Reuters. U.S. consumer confidence ebbed slightly in January, with more consumers planning to purchase homes, automobiles, and other big-ticket items, even as they grew less optimistic about business and labor market conditions in the short term. The survey from the Conference Board on Tuesday also showed consumers' inflation expectations moderating for a second straight month, though still high. Labor market views softened a bit, likely reflecting the disruptions on businesses caused by the winter wave of COVID-19, fueled by the Omicron variant. Sounds very scary. While consumer confidence dipped this month, consumers generally have faith in the strength of this recovery. Sure, said Robert Frick, corporate economist with Navy Federal Credit Union in Vienna, Virginia. The conference board said its consumer confidence index slipped to a reading of 113.8 this month from 115.2 in December. Economists polled by Reuters had forecast the index falling to 111.8. Despite this first decline in 4 months, the index is well above pandemic lows. The survey places more emphasis on the labor market, which is tightening amid worker shortages. The cutoff date for the survey was January 19th. The University of Michigan's Consumer Sentiment Index fell moderately in mid-January. The Conference Board survey measure of current conditions rose, a sign that the economy entered 22 on a strong footing. Its gauge expectations for growth in the short term eased in line with views that Omicron will slow economic growth this quarter. The United States is reporting an average of 696,541 new coronavirus infections a day. Oh my God, we're all going to die. According to Reuters analysis of official data, infections, however, appear to be subsiding in some regions, including the hardest hit New York. Analysts, against the backdrop of a stock market rout, some economists viewed the decline in short-term expectations as a warning sign. Wall Street has come under intense selling pressure as investors fear aggressive interest rates increases by the Federal Reserve to tame inflation, as well as a possibility of a Russian invasion of Ukraine. U.S. stocks were lower. Yeah, well, we already know that. So it appears that people are, taking their cash and putting it into things right now. Probably not a bad idea, especially if the dollars are going to continue to lose value over the next few months, possibly years. Putting it into stuff, whether or not it's things used around your house or just assets that are going to hold value, that's probably not a bad idea. All right. Last story we got here comes from Barron's. Stocks are getting hammered. Big money is waiting to buy the dip. Written by Jacob Sonnenschein, and this was published today. Stock market is down a lot. The good news is that there's a pile of money waiting in the wings to buy the dip. The S&P 500 is down about 10% from its all-time high hit in January, putting the index officially into correction territory. The NASDAQ 100, an index of the largest market capitalization companies in the tech-focused NASDAQ composite, is down almost 15% from the record high it hit in late November. Driving the declines is the expectation the Federal Reserve will lift interest rates several times this year and reduce its holdings of bonds to stave off inflation. Higher rates could choke off economic growth, while higher yields on long-dated debt, like the likely result of cuts in the Fed's balance sheet, make future profits less valuable in current terms, causing stock valuations to decrease. It feels like the sky is falling. Markets may need more certainty about what the Fed is going to do before stocks can rise again. But there's a boatload of money just itching to buy stocks. That became entirely clear on Monday from the S&P's low point of the day of 42.22 to its close. The index rebounded 4.4%. It was only the 13th time since 2013 that the index has achieved a rebound of at least 4%, according to Istanet. The Invesco QQQ Trust Series 1, an exchange-traded fund that tracks the NASDAQ 100 index, closed 5.1% above its intraday low of $336 a share. Professional traders and investors were emerged in droves. Were emerged in droves to scoop up beaten down shares as of 12:30 p.m. when the stock indexes were deeply in the red. Traders placed nearly 8 billion more sell orders than buy orders, according to the J.P. Morgan data, looking at trading across the market rather than just via the bank. But by the end of Monday, when indexes had moved into positive territory, the dollar tally of buy orders for the day exceeded sell orders by almost $10 billion. The majority of the buying was from institutional investors, not retail traders like those on popular platforms like Robinhood. So it appears to have been deep-pocketed pros that were responsible for the market turnaround. This is a good sign for those looking to buy the market's larger dip. And it's just the buying and it isn't just the buying activity on its own that could easily make someone optimistic about the market. There weren't many people sitting on the sidelines indicating that Monday's buying action may have been representative of what the market is likely to do when stock prices get to those lows. Trading volume was high, about 68 billion on transactions on Invesco QQQ Series 1 occurred Monday. That is the highest volume since at least 2015. It's a sign that buying a dip isn't a bad idea right now. Just remember that on Wednesday, the Federal Reserve will detail the results of a policy meeting now underway. If the central bank delivers worse news than expected, the stock market is not going to be happy. So, I agree with buying the dip. I personally just don't think this is the dip to be cashing out or throwing a lot of cash into right now. If my own personal opinion, I would hold off. I would see my personal expectation is that we'll see a much larger downturn during the course of this year. Again, this is just my own guess, but Anyways, all right. Well, that's everything I had for today. So sorry for the frog in my throat. I just worked out and all that gooking stuff was caught up in my windpipe there. So, all right. Well, everyone have a fantastic evening. I'll be back tomorrow on Wednesday. Well, I might be a little late. I have an infusion tomorrow. So it might be a little later in the afternoon by the time I get back to here at the office. So, like I said, if anyone needs anything from me, don't hesitate to reach out via email or phone, and have a great evening. Bye-bye.